Happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the Rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. As always, pleased to be joined my esteemed colleague and co-host, who this could be comical today. He's having some problems hearing with his connection. Rob, can you hear me okay with the intro here?
I can barely hear you, Rich. I'm near a roaring river on the 16th hole, so I'll try to read lips.
What are you on, a putt-putt course that Puff the Magic Dragon in the background? There's conspiracy theories.
In Reno and in the states of Illinois and Ohio, especially Twinsburg, I think miniature golf is like a new fad. Like they've never seen it before, maybe. So it's a big deal. Big deal.
I'd never been to Myrtle Beach in my life until a baseball tournament a couple of years ago. I was in just complete shock and awe of how many putt-putt courses there are in Myrtle Beach.
So two bits of trivia before we really kick into things like credit scores. So it's interesting. Different parts of the nation will say things differently. For example, Rich, what do you call it if we were to go
Rock, paper, scissors.
Okay. Tracey, what would you call it?
La shoot.
What?
See, and I call it Rochambeau.
Wow.
So
it's like the savages that call pop soda.
Oh, yeah.
Soda, sure. Soda pop. But to your point, Rich, I call this miniature golf. You might call it putt-putt golf.
Putt-putt.
There's a little bit of trivia. And once again, one other thing. Near Reno, the shores of Lake Tahoe, the North Shore of Lake Tahoe, and local residents know this. If you ever go to Lake Tahoe and you go miniature golfing or putt-putt golfing there on the North Shore, Kings Beach, the miniature golf course is owned by the Three Stooges' Shemp's granddaughter.
Wow.
Shemp's granddaughter owns a miniature golf course there. So if you ever wonder what happens to, heirs of the Three Stooges' fortune, that's one thing.
What other podcast are you going to get this type of quality information? I mean,
I can't wait to use this information somewhere else in life.
Good reminder to pitch the podcast to our live audience. Amy, if you could link the podcast feed in the chat, really growing a nice base podcast listeners. So always forget to encourage our live audience to subscribe to our podcast feed and give it a good rating. Evidently that helps things. I never mentioned that till the very end of the show. So there we go. Anyway, well, I failed to introduce our co-host, a familiar friend to the Rundown. A lot of credit-related stuff and topics right now in the mortgage industry. So I always like to go to our credit expert, COO, Partners Credit, Tracey King. Tracey, great to see you.
Good to see you. Glad to be here. Longtime listener, third-time caller, or fourth, one of the two. And I was trying to compete with Rob because he's always on location somewhere. And I thought this was better than my inside of my house, but we'll see how it goes.
I just finished up a round here, and I'll be darned, I always fall for the old 18th hole. The ball goes back in the shop, and I never come away with a souvenir blue or green golf ball to use in actual golf. So that just shows the level of capital markets intelligence, Tracey, that you're dealing with here.
Well, I'm glad I'm in similar company for what I'll contribute to the capital markets talk.
Yeah.
All right, well, let's go ahead and get into it. As always, any questions, comments, jokes, anecdotes, drop them in the chat, the Q&A. We will go ahead and incorporate it into the show. Rob, this week, the Fed continues to be in the headlines. They had a meeting this week, raised, as we anticipated, 75 basis points. This was off the heels, though, of Tuesday's GDP report. GDP expected to come in a little higher for Q2 than Q1, the measure of the economy as a whole, one of the big economic indicators everybody's looking at. GDP actually comes in 1% lower in Q2 than Q1. Inside of that, there was some labor-related tenets to it that concerned some people. If you look at how the markets reacted, which is funny to me, the bad GDP number raises expectations of a recession, which helps bonds, obviously, the safety, the security of the fixed income bond market. But stocks rallying off a recession. The stock market wants a recession right now. So,
how about that stock market? What the heck?
I've switched my focus to sports collectibles.
Yeah, no, let's not talk about stock market. I read
This is going really well.
There's an altercation breaking out behind me on the right, on the who's closest to the pin. Years ago, Rich, I read a book called A Random Walk Down Wall Street, and I'm a firm believer that being able to predict the stock market's activities or the bond market's activities is nearly impossible. The best that lenders and investors can do is just try to keep their knees bent and be able to react and just plan their businesses regardless of what rates do, or in this case, what the stock market does. But sure, the GDP came out, the gross domestic product, and of course, there's all kinds of numbers contained in there. And immediately people say, well, that's a backwards looking number anyway, yada, yada. And then they start talking about the risk of a recession. And then people on bond market investors say, oh yeah, recession, that means lower rates. And so the yield curve, tips a little bit more, but the longer term rates come down. And it's important for listeners to remember that the 30-year mortgage rates don't trade off Fed funds. They don't trade off 30-year bonds. They barely trade off the 10-year, and we talk about the 10-year yield a lot because it's quote, the benchmark yield. But in general, mortgage-backed security traders use 5-year treasuries, 7-year treasuries, because if you think about how long the average 30-year mortgage stays on servicers' books, it's something closer to 5 or 7 years. Now, granted, the current crop of mortgages that are out there that are 2 3/4 or 3% may stick around longer, especially if borrowers can find second mortgage programs or HELOC programs in order to fund other needs. But nonetheless, the 5-year and the 7-year treasury securities, they're doing okay. Obviously, the 10-year dropped significantly. We're back well into the 2s, and we were up near almost 3.5 not that long ago. So yeah, the economic news continues to point to a potential slowdown. And now what's creeping into the financial press now is talk of stagflation. Gee, if inflation remains high and the economy stagnates, then what is the Fed going to do? So it'll be, we'll be talking about it for a while, Rich, in terms of the economic news that comes out. And, you've got a whole school of thought out there that says, gee, unemployment is low, people have jobs, companies have trouble finding workers, so the employment picture is still good. The economy, the housing market is starting to, I won't say falter, but slow down a little bit, which we're probably okay with. We don't need 20% appreciation every year. We'd be fine with 5%, 7% appreciation. So, as always, we'll see what happens. It's impossible to predict. But one of the things that I wanted to bring up, since Tracey's on here, is the talk about when I talk to loan officers about the current economic environment and the risk of recession and so forth, and what kind of loans they're seeing now, Tracey, they're telling me, well, all the all the easy loans are done. And who we're dealing with now are potentially lower credit score borrowers, self-employed borrowers, borrowers who may not have a traditional risk profile. Is Partners Credit, are you at Partners Credit seeing that?
Well, I mean, it's a good question. And we kind of talked about this a little bit before in terms of like where the scores have been and where they're going now. There has been a steady decline. So January of last year, they were around, mid scores around 720, 730. And right now what we're seeing is mid scores around, right around 700. So there is a dip there, and it definitely brings borrowers into different brackets. But I don't think it's as significant as people are up against. I mean, it is a different kind of loan. It's a different kind of, refis versus purchase loans. They're different in how you work with them. But I think there's a different pace with it and a different kind of borrower where you might need to spend a little extra time of looking at it or bringing them into once you pull that credit and look at that score, scores are fluid, and that's something important to know. And so is, the process of a purchase loan, when they walk in the door to when you're able to close that, there's time, and there's time to work with your borrowers to understand where they need to be. And it can set yourself apart as a lender of, listen, you're here right now. Let's take a look at your credit profile, what that looks like, and if there's ways to improve it. So right now you might be at a 700, but there could be a possibility you could get that borrower up to a 720. It's just what you can do with them, and having the wherewithal to kind of take a moment, pause, have someone on your team that understands it and put forth that extra effort. And that extra effort, honestly, once you are familiar with it, it doesn't take a long time. You don't need to move past it. There's tools out there you can use that can benefit the borrower and you. That's what they remember. They don't remember how quickly you can, spat off like what rate you can get them and what the pricing would be. If you take the moment to pause and say, all right, here's where you're at right now. What are we looking to do? What are your goals? I know this has come up for you guys before, of what are your goals as a borrower? What are you looking at? How do you want to spend that money? There's options there.
So, well put. I had a question. I'm not a credit expert, although I play one on TV. For listeners who are viewers who are relatively new to the industry, FICO this, FICO that. First of all, there are other credit scoring models, other credit scores, and maybe we could talk about that in a bit. But FICO, from Fair Isaac is relatively well known. For somebody who doesn't follow the credit world, and I know I've heard this several times, but I always seem to forget, what makes up a FICO score? Where did that, Fair Isaac came up with it, but what components go into it? Because I think originators need to be able to coach borrowers in terms of getting their credit score up. And so what brings a credit score up or down?
Yeah, so there's 5 main attributes that go along with it. And the importance is understanding what holds the heaviest weight. So I think it's like 30 to 35% with that is payment history. So making payments on time. Then it looks at another 30% would be how much you owe on it. So if, what's your credit limit versus how much you've taken out on that. Then it kind of drops significantly after that. It goes down to like 15%. And then it's the amount of time that's been open. And then even less than that is how much new credit do you have? So they're looking at, are you going out and getting new credit cards? And then the types of credit that you use. So the difference between a credit card or an installment loan, those vary differently in how they impact your score. So, you're looking at the most is your payment history. Are you late? When does that fall off? And then it kind of trickles down from there.
Thank you. Are there services that borrowers can use or that loan officers can recommend borrowers use in order to boost their credit score? Or do you think that loan officers advise clients on their own in terms of trying to raise credit scores?
Um, in my opinion, there are ways that borrowers can get out there and do research, but that's a lot of information. If you want to add value and again, make yourself stand out, it is not that tricky. And, I'm sure there's credit repair companies out there that will hate me, but you don't need to use a credit repair company when it can be simple steps. So it doesn't have to be super expensive. You really just need to take a moment to look at these different attributes and how it's impacting the score. So most of you that use a credit reporting agency like myself, there are tools that you can use. One's called Credit Expert, and you can either simulate what a change to, if I bring my Visa card down $500, what is this going to do to the score? Or if I wait 60 days, what is this going to do to my score? All of those things can be accessed fairly simply. But again, borrowers have access to it. But just like anything else, I'd rather come to you if I had a question about the Federal Reserve and have you answer it in 20 seconds than me sitting there trying to break apart all the different websites that are available to me in very confusing terms. You have the ability to break it down in a simple way. And I encourage everybody to kind of reach out and talk to members of their team. And if that's where there's some holes, you can fill these in pretty simply by reaching out to, whoever you're using as your CRA should be able to sit down and review this with you. And we've seen a lot of our customers do that recently because it is the time to kind of stand out, make sure that the information you're giving is relevant and correct, and not sending them off saying, oh, hey, talk to this credit repair company, come back to me when they fix it. It just turns, you're putting the onus on the borrower rather than providing them with the service.
So speaking of correct and incorrect, 2 or 3 months ago, and I wrote about it in my commentary, I think I might have been one of the first, the Experian, snafu, the alleged miscalculation. I don't know what the correct legal term is for a company messing up their the score and potentially putting borrowers, or I should say, having borrowers read those incorrect credit scores and put those borrowers into mortgages that may have not been priced appropriately given the borrower's real credit scores. What's happened with that whole Experian issue? I know Fannie Mae and Freddie Mac addressed it, but where does it stand? What should lenders know about that now?
Well, one, a big thing to know is that it was Equifax and not Experian. Yeah.
Oh
so
my
they
gosh.
might not be too thrilled. So Equifax.
Equifax. Oh
Yeah,
my God.
not much has come from.
Hold on, Tracy, hold on. Folks at Experian, I'm sorry. I'll be glad to.
The Godiva baskets in the mail experience.
Right.
Yeah.
Tomorrow in the commentary will be a nice blurb about Experian and their services. Yes.
Right. I don't. People who I've talked to know that I live my life trying to avoid emails with signed by general counsel at the bottom, and I'll imagine I'll be getting one this afternoon. So anyway,
Right.
Tracy, go ahead.
No, I mean, from what I understand, it was a lot of kind of waiting and seeing and hearing back from how people should move forward from it, because you had, Freddie and Fannie's response, but then, there's other lenders out there that were waiting to kind of see what their next move was. From what I've heard, our involvement of it was to get that information out to our customers as quickly as possible so that they could research it, and then it kind of placed them under some scrutiny as to what they needed to do with it. But for what I know right now, it's been communicated of how they should deal with it, and from what they understood of how things lined up, where they might have lost some money or made some money, it kind of evened out. It was more so figuring out how to contact whom and how to alleviate that. But I haven't heard anything honestly about that in a couple of weeks.
All right, thank you. What about the the FHFA / Fannie Mae / Freddie Mac accepting other credit scores besides FICO. Every once in a while, that kind of pops up in conversation, and then it kind of dies down, pops up, dies down. And if you ask anybody from Fannie Mae or Freddie Mac, I know a lot of great people at Fannie Mae or Freddie Mac, but they're forbidden from publicly talking about the future. Ask them what they're going to have for lunch tomorrow. They say, I can't talk about that. So if you ask them about what's going to happen with terms of credit reports and credit scores and so forth, they won't say. Have you heard anything about FHFA, looking at other credit scoring models?
I haven't, other than, this was a big topic that came up when we were in Miami, and there was a breakfast where we all were talking about this and different scoring models. And I spoke with someone at Vantage Score who was very excited about it because they had felt that it finally got to a point where something was going to happen, and we're just waiting and weeks away, and we're, weeks away from hearing something. And that was in April, and we still haven't heard anything. So with that, I mean, for those who don't know, it's discussing having a different score model other than FICO, which is interesting because they keep making some changes or requirements. The CFPB recently changed how medical collections should be reported. And there's been some talk about that. And then when the CFPB brought it to everyone's attention and how many credit reports this will affect, and if it will actually help borrowers by removing that, part of what they were saying, and I'm paraphrasing, but that most lenders are using an antiquated scoring model where it won't impact as much as it should. And what Vantage Score was saying, and I'm sure there's other, Vantage Score was waiting to hear if they would be the accepted score. So I'm sure there's others in the running, but I can't speak on that as much. But what they were showing, and I know you guys wanted to talk about affordability and credit worthiness of borrowers, but what they're really talking about is you have a pool of people in which, what we were talking about, the attributes, payment history is the number one thing. Well, if you don't have a huge payment history, if you haven't had open credit for 5 years, and that means you don't get a score. They're saying with different models, you can look at it and you can develop scores for these people and access loans for a pool of the population that hadn't been able to access that before. So where it stands, we're still waiting.
And from your perspective, Tracey, just as somebody that runs the day-to-day for a fairly large credit services provider, you have any preference on it? Sandra Thompson at our conference in Miami, she was very candid and said, listen, we're still weighing this. She formally asked our live audience, our live general session for feedback. We opened up something we sent out via text where people could give her their direct feedback. She said they're looking at, basically 3 options. Keep what we have now, FICO, replace FICO with something like Vantage, or allow both. But then within that, would it be the low higher of the two, the lower of the two? Yeah, So what are your thoughts on the issue? What would you like to see happen?
Well, one, I think that scores are expensive, and everyone talks about the price of a credit report as is. And I think there should be competition in any kind of market in dealing with this. And it should be also something that if we're constantly having these conversations of making sure that we're on top of our industry and what we have access to in terms of borrowers, yes, this is something that is well overdue and should really be looked at. And I'm all for it. The implementation of it is going to be very tricky. And then also, I imagine there will be a time will be a pick 2 for testing capabilities that, you need to see how they're going to vary between one another and what that actually means. But with that will be a cost, because then you're paying for a FICO score and another score, and that's going to impact people too. So the question then becomes, is it worth the extra investment could it potentially bring in more borrowers that you have access to? So it's,
Feels
I
like
think-
something's coming soon here from FHFA. Nothing but pure speculation on my part. I would imagine we're going to get something on this in August, and it's probably going to be like pick your multiple score option of some sort. This will be a real long runway, though. It'll be like a Jan 1, 24 implementation, if I had to guess.
it will take time, but I'm hopeful for it. It does seem like there is more discussion of scoring model that the CFPB has been involved in more recently, and issues with credit in the bureaus. So I'm hopeful that that causes some movement. And, like you said, the discussions that we've had and questions that have been asked, it's prevalent in their minds. And that's, I think, really good for our industry.
Rob, you done interrogating Tracey? Tracey, any thoughts on the Deshaun Watson suspension? Any predictions there?
No, I'll let you guys handle that one.
My Guardian's ahead of your White Sox in the standings. I had to note that at some point in the show. So,
oh, great. I knew all about that, and I was about to bring it up myself. So thanks for beating me to the punch.
Rob, Tracey, a lot of other stuff in the news this week. The House passed the remote online notarization bill. In headlines you thought you would have seen in 2018, and off to the Senate. We'll see what happens there. Freddie Mac, $2.5 billion net profit in what was an abysmal second quarter for the housing market. So all the, just, take Fannie and Freddie out from under the government thumb. There's that whole like $30 billion a year they're making that needs to be atoned for. That's mostly getting pumped right into the government. Pieces on affordable housing issues. New York Times columnist essentially calling for the federal government to get into the home building business. Anything in there, Rob, that tickled your fancy this week?
So I think I heard part of that, Rich. Like I said, there's a rushing river here by the 16th hole, but
Some smoke
Fannie
just
Mae,
came out of the dragon's ears there, Rob.
What's that?
His ears are the dragon's ears.
Yeah, some smoke just, yeah, exactly, right. There's a theory that Puff the Magic Dragon is not a harmless children's song.
Puff the Magic Dragon, North Shore of Kauai, Honolulu. So I would say the average person, and I would put I'm not gonna downplay Fannie Mae and Freddie Mac's earnings, but I will say the industry is much more tuned in to the remote online notarization. I think that's Tiffany shot up a comment about fingers crossed. I think as an industry, to be able to help future borrowers, the technology needs to step up. And unfortunately, I made this comment in my commentary. I think the average age of a senator is 88 years old or something. I don't know. They don't even have cell phones and so forth. But so they don't understand the issue. They especially don't understand the technology. I hardly understand the technology, but I know that when I can sign something or have it notarized remotely, I think is an amazing thing, and is definitely needed. And especially if people don't, the scheduling doesn't work. Maybe they're watching kids, and I know notaries will come to your house and so forth and so on. But I think it's a big step for our industry to be able to automate some of these things. And so I know that the House passed it. We'll see what happens with the Senate. I don't know why the Senate wouldn't pass this. More specifically, I don't know why the somebody wrote something there. Maybe Rich, you can take a look at the comments. But typically, anybody who's done a legislative day at their state or federal level, they know the assistants, they know the recent graduates of law school or undergrad poli-sci who are working for these politicians. They tend to understand the issues much better than the actual politicians. So hopefully the staffs of the senators will advise them to put, to move this forward. Of course, the Senate has other more pressing issues to deal with, but nonetheless, the it's I think it's a big step in the right direction. What are the comments saying, Rich? The questions.
63 is the average age.
Oh yeah. All right. Yeah, I mentioned it's 63. All right, fine. But for every Diane, yeah, for every youngster, there's a Diane Feinstein who's 88 or 89 and may not know where she is at any given moment. I'm sorry. Did I say that? I'm sorry. I stay away from claims like that. Anyway, big fan of Diane Feinstein from 20 or 30 years ago.
There'll be a comment about her tomorrow in the commentary too, right underneath experience.
No doubt. No doubt.
Proactively apologize to Experian.
What are the other comments saying?
Just about Puff the Magic Dragon and
they don't go to the grocery store. Why would I sign in person? They appreciate a good jar drink.
So, what about the Rocket Mortgage, biggest mortgage company in America, sponsoring the golf tournament this weekend, the whole Live Tour? You guys, any caught up in any of that drama with pro golf and this competing Saudi tour? Anybody? Anything on that?
I don't have anything on that. I'm sorry.
What did Rich say? What?
The Live Tour, the Rocket Mortgage Classic this week, sponsoring the PGA Tour event, Rocket Mortgage this week. I was just asking if you had any opinions on the whole Live Tour drama with pro golf right now. Nothing. Okay.
Do you have thoughts on that, Rich? Let me throw that back to you.
Yeah.
It's entertaining to me. And to some degree, these guys got rich off the PGA Tour, and now they're kind of screwing the PGA Tour. So there's that component to it. But it's interesting to me as somebody that just appreciates sports and drama and storylines. And they got 22 of the top 100 golfers, I think, that went over. So yeah, I think ultimately it'll be cool to see like the rivalries develop. So between guys on the different tours, but. My stepdad, he's like hardcore golf fan, and he is like up in arms about this Live Tour and how the guys are screwing the PGA Tour over. So, but figured I'd mix it into the conversational rotation this week with the Rocket Mortgage Classic going on in Michigan. What about this New York Times piece? Was really interesting. They don't go out directly and say the government should get in the home building, but they make some valid points. They make points we've been making on this show for well over a year now about housing stock in America, about how there is no relief on the horizon unless we're all missing something or there's a huge fall off in housing demand, that this is a problem that's just going to get worse and worse, and there's zero solutions really. Some of this stuff in the Biden housing supply plan will help maybe a little bit on the margins, but so the columnist goes on to say, basically, if we don't do one of two things, either one, incent builders to build smaller $150,000, $200,000, $300,000 homes, or the U.S. government's got to step in there and do it, because this is something that needs addressed in America. Rob, I'll start with you. Your thoughts on the piece.
You can't hear.
Something about small. Is Rich promoting tiny homes again? What was?
Yeah, it's the article. It was whenever you have an acronym that goes into something, I think they talked about that in the article, where it was the not in my backyard. And so it's now NIMBY. NIMBY, what can you do? And that people are saying, sure, yeah, I support it all the way. And then when it talks about, where they're going to do it and what it looks like, then it totally takes a different turn. And what can you do to get people to do? How can you incentivize it? Either the builders, the lenders.
First of all, I need to apologize to I'm on
everyone.
I'm on a street.
Experian and Diane Feinstein.
Right. So, but I need to apologize because I have misspoken about Dave Chappelle saying that if you're going to build affordable housing near my comedy club, I'm going to back out of building the comedy club. As it turns out, a very astute reader pointed out that Dave Chappelle, that was not his discussion topic. His discussion topic was or his point was, there aren't enough affordable housing units. The project, he's trying to promote more affordable housing, and not that they're going to build it at all. So hats off to Dave Chappelle. Certainly hats off to who alerted me or alerted us to that fact. The it's interesting, Rich, how the affordable housing is, we talk a lot about affordable housing, and I make jokes that builders don't even know how to spell affordable. But the fact of the matter is, lenders have to have products that appeal to maybe not tiny homes, but be able to attract or apply to people who are going to buy affordable houses, people whose median incomes are less than a certain percentage of the area's median or income, and so forth. So the question that lenders have to ask themselves is, this is all going up, this is all going on in the government, but what do we have to offer people who might have, to Tracey's point, a slightly lower credit score or income less than the median and so forth? How can we help those borrowers if the government ever is able to push forward some of these initiatives and have the builders do it, and have the builders do it through whether it's tax incentives or not having to pay $50,000 or $100,000 a unit for permitting costs that are put on by the local government, which the federal government can't influence. So typically, Rich, I'm going to put on my blunt capital markets hat here, but we're in an industry that's driven by money, frankly. And if you can monetarily incentivize, and I don't know if incentivize is quite the word, but promote these companies and these builders, individuals and so forth to do it, I think that would be the way to go.
A lot of comments in the chat about the live tour more than anything, really, but also people praying for our industry if the government gets involved into the home building side of it. We got to have Jerry. We talked about this last week. We got to have Jerry Howard from NAHB back on again. I'd love to get his refreshed thoughts on everything going on.
I was talking to your very own Jim Park this week at the Western Secondary, and he was saying that his beginnings was as a lobbyist for affordable housing. You guys should have him as a panelist sometime to get his. I think everyone has different views on it, but if we're in a place in our market where our profits are shrinking every year and the cost of a loan is higher every year, and you're making nothing on a loan, what does make you do it? The kindness of your heart?
Listen, it's a tough situation. If you're an independent mortgage bank, you're not funding loans with your own money. You're not sitting on a lot of capital. So if you have to buy back loans, depending on the size of the company, even a few can be really painful. So lenders have to make good decisions. That's why you've seen, coming out of the meltdown, especially lenders not underwriting to the full extent of the credit box as credit guidelines started to expand. And if you're a community bank, like what you put in the portfolio, I could tell you, having experienced that, especially post Dodd-Frank, anything you're putting in the portfolio that, has any hair on it whatsoever from LTV or credit score, or really got to explain it and reserve more capital against it. So not quite as easy as just everybody's got to lend,
Right.
there's a lot of tentacles to the whole affordable housing thing, but it certainly is going to continue to be a focus of the Biden administration. I read a piece this morning, Kamala Harris and Marsha Fudge doing the roadshow, doing some speaking last couple of days at sites of housing related projects that the administration's engaged in, and speaking about some of the accomplishments that the administration's had in their first couple of years here. But it's all about to come into the forefront right now, because these housing issues, they're go to the front page of CNBC.com or CNN.com almost every day. It's something about housing, supply, inventory, rates, and it's going to be really, really interesting when the conversation becomes more national as the elections get closer in November.
I will say, just I've been in our industry as you guys for much longer, but I haven't had as many people ask me questions that had no involvement in what I do, or, what do you do again? And I know you deal with credit and whatnot. And it all seems like, not everybody is tapped into the Fed. Not everybody is tapped into, why does it matter that the interest rate went up 1 point if you're already in your mortgage? They're not as tapped into it, but lately more and more people that have, that never were interested in before are, because it is showing up more and more. Just like the leaf blower man just showed up next door.
Gotta love the timing on that. So this is the Rundown with Rob and Rich Rubinski with the Mortgage Collaborative, joined as always by Rob Grisman, and this week the Chief Operating Officer of Partners Credit, Tracey King. Just a couple minutes left. Rob, what do you got planned after the big miniature golf round for the weekend?
What do I have planned after this? Well, Rich, I'm thinking about downing a couple Gatorades and having a power bar, going out for another 18, because I really had trouble with this earlier today with the anthill on the 4th hole. Really got the best of me, so I'm hoping to, conquer it. And there was that windmill, the dreaded windmill on the 9th hole that I had trouble with. So I may go back for another round. If I don't do that, I'm going to have lunch with the local national MI rep, which will probably be what I do. And then tomorrow I've got tennis with an ex-carpenter who has a titanium leg, but that's a tale for a different show. But anyway, Tracey, what are you up to?
This weekend, I'm enjoying summer and the end of summer as much as possible as we head into August. So outside with my kids and splash pads, pools, birthday parties, all the things that are fun, and not dealing with any of the stuff that's not.
So Tracey, Rich is about to trump both of us because he's probably got some
Concert.
wiffle ball
Oh,
extravaganza leading up to his Harmonicats concert, or whatever band is touring through Twinsburg.
Funny comment in the chat. Experian just pulled their anthill.
that was a good one.
So we once again would like to apologize profusely to Experian, Diane Feinstein, Dave Chappelle, and anybody else that was affected by anything we've said these last 42 minutes. So that should cover us, right, Rob?
What? Anyway, all right.
No exciting weekend plans for me. Starting to get ready for the World Series of Wiffle Ball in a couple of weeks. 175 teams from all across the Midwest, and other than
Streamed on YouTube. Can we watch the action happen? Or
yeah, there's definitely some stuff on YouTube from past tournaments. We have not talked about live streaming it, but this year we got a live band, a mechanical bull, temporary tattoo artists, and all kinds of other crazy stuff, dunk tank, and all kinds of obnoxious things. So
what customers do I have where I can make a visit out there to make it, business and professional wiffle?
Good stuff. Well, as always, thank you to our attendees, our live audience, our after live audience that watch on YouTube, and our podcast audience. So once again, implore anybody watching on YouTube or live here, the link to our podcast feed is in the chat. You can subscribe there, give us a nice rating, say nice things, and good things will happen to you. So, but Rob, as always, enjoy the conversation. Tracey, thanks for joining us on little to no prep.
No, this has been great, and I look forward to seeing everybody in my hometown, Chicago, for TMC in September.
September 27 to 29 in Tracey's hometown, the Windy City, Chicago, Illinois, at the Lowe's. Going to be a great event. We're tracking towards almost 600 people, and great venue, great town. Should be a lot of fun. MortgageCollaborative.com. Anybody that wants more info on TMC in Chi-Town. So with that, until next Friday, have a great weekend, and next week, everyone. Take care, guys.
Hi, thank you guys.
Bye, guys.